The deals we buy, no one else sees on the market. They're not sitting on LoopNet or the multiple listing service or the internet. They are off-market deals. You get a phone call from a broker you know very well. He says, I have a deal coming up. Here's the best price. Here's the details. We go out and see it. We underwrite the deal with our in-depth institutional level underwriting team, and we submit an LOI effectively and quickly. And the brokers know we close well, but they also know we need a good price. So we get off-market deals that way. All right, ladies and gentlemen, my name is Aaron Fragnito. Thank you so much for joining us this evening. I see more people are jumping on. Great to see you here. Tonight, Seth Martinez, my business partner, and I will be speaking about PCG projects, our current projects here in Northern New Jersey. And we'll speak about how we've been helping people build and preserve their wealth in Northern New Jersey for over a decade, and how those projects are going and why we choose to reposition multifamily housing for private investors in this state where a lot of other syndicators do not choose to invest. So we'll dig into our projects tonight. We'll speak for about 45 minutes. If you have any questions as we go along, I encourage you to put them in the chat here. And if you have any technical difficulties as well, encourage you to put those in the chat as well. As we get started here, we have a interesting group here. I'm curious who here is from New Jersey, or what parts of the country are you from? Put in the chat here where you're from. I see some familiar names here and some new ones as well. We have investors all throughout the country, although about 75% of investors tend to be in the tri-state area or have some relationship to New Jersey. Maybe you grew up here, maybe you went to school here. Put in the chat where you're from or where you're living now. And we have a great list here of different people all around the country here on the chat. So let's get into it here. If you have any questions, put those in the Q&A. I'm going to answer all questions at the end. All right. Quick disclaimer, this is not a solicitation for funds, tax advice, or legal advice, but we'll explain how we reposition apartment buildings for our passive investors here in Northern New Jersey. We're going to go over the executive summary of our company, People's Capital Group overview, our investment thesis and pipeline. We'll cover some case studies, and then we'll dig into our real estate portfolio, our current projects, and we'll even touch at the end on our next investment opportunity, which is coming up very shortly. So we'll talk briefly about that as well. So since 2013, People's Capital Group has been helping investors build and preserve their wealth through bespoke real estate investment opportunities located in Northern New Jersey. We focus on multifamily and mixed-use buildings. Mixed use means there's a storefront and apartments above it. Seth and Martinez and I have done about 279 transactions in New Jersey together. About 83% of our investors reinvest after liquidity events. We have about an 83% retention rate. We have about 100 private investors, high net worth individuals, and family offices that invest with us here in Northern New Jersey. So quick snapshot here. We started our company in 2013. We have about 39 million in assets under management right now. We do buy and sell properties. We normally sell every 5 years or so. Some properties we aim to refinance in perpetuity, but a lot of them we plan to sell. About 98% of our transactions since inception have been in New Jersey, so very Jersey focused. We have a couple deals here and there in the tri-state area, but for the most part, mostly Jersey focused here. About 191 apartments right now under management. We manage them in our own in-house management company. So we are a vertically integrated real estate investment firm. We do all of our management in-house here, People's Capital Group. We're actually located in Somerville, New Jersey, right here on Main Ave. So come check us out. Let's grab some lunch together. We've been, Seth and I, both in real estate combined about 30 years, helping people build and preserve their wealth in real estate. Both of us for about 15 years each. We have 12 members on our team. We've completed about 11 syndications. A syndication is where you pool capital together and buy an apartment building or a larger piece of real estate. And we've raised about $18.6 million in our careers together, Seth and I. We've returned about $8.4 million of capital to investors. We have about 32 properties here, unit count of about 191 units. You know what, Seth? I'm going to let you jump in here on this slide since you're on the operations end, the management end, and you focus on keeping these properties occupied. That's a strong occupancy rate. Here's Seth Martinez, my business partner.
All right. Thank you, Aaron. Yes. So over the course of the last 12 years, as we've built this company in large part with our investors, we have built a portfolio of about $40 million in real estate that we're currently holding, as Aaron mentioned. And about half of that is with our investors as we help them build and grow their wealth together with us. And we've also bought, and sold, as Aaron touched on, it's not included in the portfolio, over approximately $60 million other additional real estate that is no longer owned by us. And we continually analyze, the least performing real estate in the portfolio and turn over those units and those properties and move the company's funds as well as the investors' funds into better real estate opportunities and better locations. So yeah, this is a snapshot of the portfolio and 191 units, 99% occupancy rate, as Aaron mentioned as well. And we have our own management company that we've cultivated and built since 2015, and that really helps us maintain maximum control over the properties and over the cash flows and extract maximum value over from the assets that a lot of our competitors can't do because they outsource the management, but we have it in-house. So we are really trying to make things, as we say, better, faster, more efficient in every aspect of the business. As each year comes and goes, we want to get better and better. And having management in-house helps us execute in that part of the business. So I'll hand it back to you, Aaron.
Thank you, Seth. Yeah, you can see here the average cost per door, 131,000, and exit price there, 226. So we create a nice delta there between where we come in, where we exit. All right. So a little bit about our strategy here. We operate within the underserved part of multifamily in New Jersey. So we do buy in a lot of inner city areas where you can get more real estate for your dollar. We see cap rates have compressed right now, so we're able to buy properties for discounted prices. We're currently buying properties around 6 caps or so, or just discounted prices compared to what they would have been a couple of years ago. So real estate is on sale, which we love to say right now. So we tend to buy about 50 to 100 unit buildings at this time, kind of too small for the larger institutional groups, but too big for your average mom and pop investors. So that's the sweet spot that we like to strike in with our acquisitions. We have been doing this, as we said, a long time. So we have a network of brokers, attorneys, wholesalers, developers, owners to get access to off-market deals. The deals we buy, no one else sees on the market. They're not sitting on LoopNet or the multiple listing service or the internet. They are off-market deals. You get a phone call from a broker you know very well. He says, I have a deal coming up. Here's the best price. Here's the details. We go out and see it. We underwrite the deal with our in-depth institutional level underwriting team, and we submit an LOI effectively and quickly. And the brokers know we close well, but they also know we need a good price. So we get off-market deals that way. Vertically integrated, as we stated, with the in-house management companies. And we really underwrite deals and operate deals focused with our investors first. So when we conduct our due diligence, when we conduct our underwriting, we're thinking at all times, what is the best way to protect our investors? What's the best way to get the highest return for our investors? How should we structure the deal with debt and equity to get the best return on investment for our investors without, but also with limiting the risk, without sacrificing, performance for risk. So we try to really always focus with our investor first approach on our deals here. And we have three main goals when we're looking at an opportunity. For our investors, we always look at the preservation of capital. Rule number one, don't lose money. right? We rigorously stress test and vet each deal. What happens if the economy goes into recession? What happens if interest rates go up? What happens if prices go down? What happens if rents stop growing? Okay, all these assumptions, right? You have to stress test these deals before you buy them to preserve our investors' capital. We also do a cost segregation study and maximize the tax benefits of the real estate to preserve investors' capital as well. A return of capital. So we have multiple times during the investment, we want to return investors' capital. That might be through a refinance, which generally takes place 3 to 4 years into the investment. And then, of course, the sale as well. Also, the return on investment, a lot of that profit is realized at the sale. So a combination of cash flow, return of capital from the refinance, and profit from the sale of the property is how we execute that return on investment. A lot of our opportunities right now, we're targeting internal rate of return, internal rate of returns to investors, a net IRR around 19 or 20%. So we target very aggressive returns on well-priced value-add opportunities here in northern New Jersey, and that allows us to ideally achieve those higher than average target returns to our investors. Seth, why don't I toss it back to you here for this for these next two slides so you can jump in.
Sure. Yeah. So, why People's Capital Group? Well, in short, it's we help people invest in real estate who don't have the confidence or the experience, or quite frankly, the time to invest on their own. And we bring 12 years of experience with transactions, and each transaction we learn something new. Over 300 transactions combined, and we have a good philosophy of constantly getting better. We're never satisfied, and there's always room to improve, and there's always the next deal. So you never really want to get satisfied. The day you find that you're satisfied in business is the time pretty much to hang up the cleats. But there's always the next deal. So and there's always ways to improve. So good transaction history. We help the people who are qualified to invest and who just don't have, again, the time or the expertise or the willingness to invest alone. And we build wealth at the same time. So we've helped over 100 different individuals and groups build their wealth in real estate by working with us. We're also vertically integrated. As I said earlier, we have the management in-house, and we can extract maximum value and move quickly. We don't have to put a call into a company and hope they react to the call. We can have a meeting on site if there's an issue and address a problem right away, and also monitor the results very quickly. So being vertically integrated also with the contractors, kind of all the way from Aaron and Seth all the way through to the janitors, and making sure everything is done at a high level of quality, discipline, and attention to detail. Always looking to improve things. And also just to wrap that up, 12 years in the business, with our sights set on the next decade, and we want to make our company better in every way in the next decade, and bring our clients, our investors with us. Okay, yeah, and the track record again goes back 12 years with each deal, with each opportunity, whether big or small, single family, two family, all the way up to 40 and 50 plus units. We always want to apply what we learned from the prior deals and make the next deals that much better. So we have an 8.6% average increase of the rent roll every year, and having the in-house management helps us get the rents up. Talk to the tenants. Each tenant kind of has to be coddled sometimes differently. They all have personalities, but the key is to gain their respect. We don't want to be their friend, but we want to have their respect and give them the value that they're looking for, and in exchange, get the rents to where we need them to be. And we have a 15.1 average annualized cash on cash return for our investors. You can kind of compare that obviously to the savings markets today, the money markets. They're at 3, 4, sometimes 5%, but so we're definitely outpacing those, and even the stocks, kind of volatile, can be as low as -5 or up to 15 to 20%. But with the real estate, we're giving our investors sort of the peace of mind and less volatility compared to the stock market. And yeah, completed syndications. We have 11 of them. Aaron is creating a new one right now, so this will be number 12. And we're excited about that. And then 83% of the reinvestment rate for the investors. So it's a very good rate. And we don't always have availability to invest. We do give sort of a first come, first serve to the existing investors. But as we grow, we hope to have more opportunities for everybody.
All right. Thanks, Seth. I'll jump back in here.
Sure.
By the way, in our chat, I noticed everyone was writing to Seth and I. If you in the chat, when you respond, put the message to everyone. You can see when you write something, you could say to it. It's set so it's going to go to host and panelists. But if you could switch that to everyone, we can actually have a fully integrated chat here instead of just messaging Seth and I, which is always enjoyed. But I'm curious in the chat here if you're a PCG investor, if you've invested with PCG or in other groups here in New Jersey, put here in the chat if you've invested in New Jersey or if you've invested with PCG. I'm curious how many New Jersey real estate investors we have here and how many PCG investors we have here as well in the presentation. So put that in the chat there and you can address it to everyone. So we are able to engage there. So this is a little background of our transaction history. You could see we used to do a lot of transactions, kind of quantity over quality. Seth and I, in 2018, we did 66 transactions, a lot of wholesales, fix and flips, and so on. It was a great time to be wholesaling auction properties and so on. But then around 2019, we realized we really wanted to do quality over quantity, start raising capital on a large scale and buying larger opportunities. So we focused on that starting in 2019. You can see our amount of transactions dropped, but the size of our transactions grew. So that was one of the main things we focused on over the last 8 years or so here, really, and to alter our business model to pivot as we saw the market dry up on the wholesale and fix and flip side and the rental market become a much more attractive place to be involved in. So we've been focused on syndicating assets since 2019 here at People's Capital Group. Here's how we source deals. We'll start with over 100 deals we'll review. We'll do a back of the napkin review. As I say, I have a kind of a basic spreadsheet. By the way, if you want a copy of that spreadsheet, you can email us and we'll get that out to you tomorrow. Out of 100 plus deals, we'll look at about 30 that we'll put into serious underwriting with our institutional level underwriting team. And we'll really run them through the ringer. It's an extremely in-depth Excel file. If you've ever seen our underwriting, it's extremely in-depth. And also, if you want to review our underwriting, you can shoot us an email. We're extremely transparent. We'll share that underwriting spreadsheet with you on our most recent offering here. You'll see how in-depth we go on these institutional level models. Out of those 30 deals, we go with serious underwriting. We'll submit about 10 to 20 letters of intent or offers. Out of about 20 offers, about one gets accepted. So it's really, we'll start with over sometimes up to 200 deals just to buy one. At that point, we engage subject matter experts for deeper due diligence to test out the mechanicals, the roof, and the physical issues of the property, environmental. We create a data room for our investors with the offering documents and the full due diligence set. We have a subscription agreement generally ready within about 30 days of putting the property under contract. And then investors have a period of time to complete the e-docs and the investment process, which is all done right through our investor portal. After closing, we do quarterly cash distributions when cash flow is available for distribution. Monthly and quarterly updates. I try to put a lot of updates into a lot of information into our monthly updates. We have quarterly financials as well, balance sheet, profit and loss statement, distribution statement that goes out to our investors, and annual K-1 tax forms. This is also all uploaded to our investor portal for each investor. So you can access all this information at any time, but it's also emailed to you, except for the annual K1. We just upload that and send you an email because that has sensitive information. Here's our team here at People's Capital Group. That's me and Seth there at the top. We're 50-50 owners. Seth's primarily in charge of operations, as we say, making sure the trains run on time. I'm more on the equity side and marketing and branding. Our underwriter, Matthew Ciancini, used to actually work with UBS. He's a really sharp guy. And again, if you want a glimpse of those models that we put together with him, they're extremely in-depth, institutional level underwriting for our deals there. We have a lean, mean team here on the marketing end. Maybe you've got a call from Muhammad Mugazi. He goes by Patrick often, so you probably got a call from Patrick if you're on our team or on our list there of investors. Chris Uger does our video and podcast editing. We have about 180 plus podcast episodes. You can find them on peoplescapitalgroup.com or Spotify or iTunes or YouTube. We come out with a new podcast every 2 weeks. And Amika does our IT and website design. Mohammed does our image and social media creation. Lena Delgado heads our property management. She is incredible. Lena is very hardworking. She's been in property management for a long time. She manages our contractors and our leasing staff, and she's extremely skilled in making sure that these properties perform as targeted. Diego works under her. He's kind of our boots on the ground. He's going to the Section 8 offices, the permitting offices, DCA, and working hard kind of out in the field with our contractors and projects. Melanie does lease renewals and rent collections. Dana Sargenti is our bookkeeper. She makes sure those ACH deposits go out on time, that those quarterly financials are done properly. And Robert Grulich is our CPA that works with us. He does the K1s, 1099s, tax guidance, tax filing, make sure those K1s go out to our investors before March 15th. We have about 8 general contractors, 2 plumbers, 2 electricians, 1 HVAC specialist, an exterminator, and cabinetry specialist. That's not even all of them. That's just the majority of the guys we keep really extremely busy. We have a number of other service providers as well. But that makes up our team here at People's Capital Group. And that's how we improve those assets to make sure we achieve our targets or come close to it for our passive investors. Seth, why don't you touch here on our years of experience here, and then we'll jump into our properties next.
Yeah, sure. Yep. So Aaron and I started doing business together in 2013. He was my realtor, and he saw me buying some properties, and we kind of realized we had the same goals to acquire wealth, build wealth in real estate, and then we realized that even has its own limitations when you start using your own money. So we realized let's start with finding others that have a like-minded goal to build wealth in real estate, and that's how we started building relationships with our investors. And over the last 10 plus years, we've sort of delegated our roles into 2 distinct areas. So sort of as Aaron, you were saying earlier, Aaron's the investor relations, fundraising, and sort of a consigliere to a lot of our clients and investors, a confidant. And we want to build good relationships with our investors. And a lot of our investors will actually call Aaron before they make a financial decision and get his thoughts on the decision sometimes. So we want to fill that role and provide sound guidance and be a true friend, myself as well. And Aaron also does a lot of the branding, podcasts, as you can probably tell, and host of the NJREN, which is a semi-annual meetup, and also podcasts. We have Passive Cash Flow podcast on YouTube, and the like. So a lot going on there. We want to add a lot of value to the market and help people achieve their real estate goals. So that's really what Aaron does more than me. And I'm more on the back end with the operations and making sure the trains run on time, as Aaron was saying, and trying to find ways to become, as a company, better, faster, more efficient, and learn from our competitors. If that, the saying goes, it's better to learn, it's good to be, to learn from yourself and your own mistakes, but it's better to learn from somebody else's mistakes. You can avoid the mistake altogether. So I'm always looking for ways to improve everything. And So that's kind of where I've come in, and we're excited about the future.
All right, great. Thanks a lot, Seth. All right, we'll jump into next chapter here. So investment thesis and our pipeline. So just a couple more slides here on why we choose New Jersey. I talk to investors all the time, and they say, "Well, I invest in Texas and North Carolina and the Smile States, the Southeast, and why would you invest in North Jersey? It's not an investor friendly city." And we actually have multiple reasons here. First of all, the landlord tenant laws change city by city. So if you know how to navigate each city's red tape, you actually can do quite well in North Jersey. There's also an inherent need for housing here. There's a shortage of housing in this area. Also, the tax advantages here with higher priced property. We can do a cost segregation study and take more advantage of the tax benefits. Capital appreciation. We see some of the best capital appreciation here in North Jersey. If you're within an hour of New York City, it's a pretty sure bet over time, the value of your asset will continue to grow. History has shown that. Serious supply and demand balance. There is not enough housing for all the people that want to live here in northern New Jersey, especially if you have an hour commute into Manhattan or less. Hard assets, real estate historically outperforms inflation by about 5%. Favorable demographic trends. It was actually awarded here in New Jersey as one of the most desirable places to live and work, with major metros to the east, New York City, and west Philadelphia as well. And favorable market pricing, we can find more affordable opportunities here in inner city areas in northern New Jersey, such as Newark, New Jersey, such as Passaic, New Jersey, or Paterson, or our next deal in Hackensack, New Jersey, that we're buying. So we see more opportunities in still high demand cities, but inner city areas where you can buy. So there's vintage housing, outdated, older real estate you can get for a great price, improve the asset, give it the amenities tenants are looking for, and create a more desirable asset that creates stronger revenue for our investors. Also, the cost of rent versus own is ridiculous right now. You can see here on this chart, it's just skyrocketed since the pandemic. This is really no secret if you've been following, real estate and economic news. The price of a home mortgage payment, prices of homes have just continued to go up here in North Jersey. It's really expensive to buy a single family home here. Rent prices have grown, but they haven't grown at the rate that single family home prices have grown. So what we see is a generation of renters. People that say, you know what? Forget it. It makes no financial sense to own a home. I can't even afford to own a home. And if I want to live in an area that I feel safe, I'm going to have to rent. So we see a lot more high quality renters with good jobs and good incomes and good credit scores wanting to live in rental units for a long period of time. And that can be great for landlords. So since early 2022, it's been more affordable to rent than own here in New Jersey. You can see these are New Jersey statistics, and it actually switched over around the end of 21 here. Early 22, it became more affordable to rent than own here in New Jersey, and that continues to be the case and the trend. A few more things about New Jersey, because we take it personally when investors say, well, New Jersey's a dying state. Everyone's moving to Florida. Everyone's moving to North Carolina. Actually, nay, the statistics show quite different. What we're seeing is there is a net migration into New Jersey. A lot of people have moved out of New York City looking for more space and more affordable housing. A lot of people enjoy the great schools here, the nightlife, the Jersey Shore, the mountains. You can go skiing and you can go to the shore in the same day. You can go party in Hoboken or enjoy a quiet afternoon in the country an hour apart from each other here in North Jersey. So it is a really, safe neighborhoods, great schools, great employment. Our inventory is not keeping up with the demands. We are short about here you can see the net absorptions, 19,637 units per year. But our households are only going up about, I'm sorry, we only have about 16,000 units coming to market. Okay, so we have a difference of about 3,000 units here every year. So we're short about 3,000 apartments here in New Jersey. We're absorbing 3,000 more apartments per year than we're building. And you might be driving around thinking, are you kidding me? There's a development going on everywhere. And there's a lot of development going on. It's slowing down. Housing starts have really slowed down. So I think next year and the year after, you're going to see a lag in new inventory coming to market, which ideally will actually push prices even higher on rentals and houses. But what we saw was a big influx of inventory hitting the market, but it really is not even enough here in North Jersey. The effective rent is up 3% year over year. Occupancy is 96.8%, one of the highest occupancy levels in the country. Employment's up as well. Households are up. So we're a growing state here in North Jersey, a great state to be invested in. And that is one of the reasons we choose to allow our investors to invest in these North Jersey opportunities and help our investors build wealth here. This talks about greater home ownership cost as well. You can see the annual home ownership rate in New Jersey here has dropped from a peak of 70% in 2005 down to 62%, to about 63% now in 2024. And we're actually below the national home ownership rate here in New Jersey because it is so expensive to own a home. It's one of the most expensive markets. So when the price of a home is so high, and you're way below the national home ownership rate, that means those people still need a place to live, and those individuals are renting. So we see a significant demand for rental here. And finally, the supply here. We are not one of the highest supply markets. This is because it is hard to develop in New Jersey. There is a lot of red tape, especially in a lot of the inner city areas. It's kind of you got to know someone to get something done type of thing in New Jersey a lot of times. And that means less real estate comes to market, less developments get the green light. Therefore, we are less likely of seeing an oversupply. Look at here in Austin, 7.3% of the market is new supply. Charlotte, Nashville, Phoenix. These are some markets that have struggled with oversupply in the last couple years, and they are absorbing it, but it's going to be some time till they absorb that oversupply. Here in North Jersey, we are not in one of these markets that's seen oversupply. And quite frankly, the red tape, it's a bit of a double-edged sword because, hey, it slows down development, therefore it slows down supply, therefore it keeps your property prices strong. And that's one of the things we like about the North Jersey market. This slide shows that it is number 3, North Jersey here on the 2024 U.S. rental markets list. This is from rentcafe.com. We have we're number 3. Miami, Florida is the most competitive. Suburban of Chicago is second, but we actually ranked number 3 here in North Jersey. With a 95.2% occupied apartments, prospective renters, 9 per unit, lease renewal rate 71%. Why not renew your lease? You're not really going to save money moving elsewhere. So New Jersey here, as you can see on the map, is number 3 out of the top 10. So we rank very highly as one of the top U.S. rental markets. All right, let's get into the meat and potatoes here. We're going to talk about some of the deals we have going on right now here at People's Capital Group. Here's an 11 unit in Paterson, New Jersey. We purchased this in July of 2022. And I'm sorry, in June of 2020, and we refinanced it in July of 2022. So we were targeting about 5 years to refinance. We were able to achieve a refinance in about a little over 2 years. And we bought it for $965. We put about $270 into it, and it appraised for $1.85 million. So we were able to get our investors an annualized cash and cash return of a little over 25% on that investment. And that was a great win for our investors. They got about half of their investment capital back from that investment in about a 2-year period. Okay, that's a nice tax-deferred liquidity event. Our initial target was 10.6%. You can see we far outperformed on this project here. And now we've recently hired Keller Williams to sell this property. We've kind of squeezed the juice out of it, if you will. We've renovated many of the units. We've increased the rents to fair market rent. We've operated the building efficiently over the last 4 years, and we generally lock in rates for about 5 years. So we want to now at this point look to sell the asset and get our investors a final payout on it. So we have listed it recently with Keller Williams. We expect to get about 2.2 million, 2.1 million for this asset. With our projections there, overall investors should expect about a 20% annualized cash on cash return on this investment over about a 5-year period. And that would be far above our target here, beating our initial targets by almost 100% or so on this investment. So that's our goal with this 11 mixed use asset here in Paterson, New Jersey. If you want to buy it, let us know. It's on the market. Well, it's not, I think it is on the market. You have to check. It might be listed on LoopNet or not. They might be doing like internal marketing to their buyers list first. So let us know if you want a repositioned 11 unit in Paterson, New Jersey. Here's a 6-unit building in Passaic, New Jersey. We bought this in June of 2020. We held it initially. We were going to refinance over 5 years. We refinanced 3 years in March of 2022 there. And then we bought this for $450. We put about $65 into it in the initial round for the renovation. We refinanced. Appraisal came in at $730,000. So we really boosted that value of the property. I think we bought it at a great price as well. We got it from a direct mail campaign, which is a great way to source properties. And we achieved about a 13.9% annualized cash and cash return to investors from the refinance. We initially targeted around 11 on this deal, so we overachieved our target there on this refinance to our investors. And then we went to sell the property a couple years later. We held on to it in total for about 5.6 years. Similar idea here. You know, we reposition the asset, we renovate the units, we increase the revenue on the building, we create efficient operating systems for, and we try to create the most value we can for our investors and create a nice place to live for our tenants. A happy tenant equals a happy investor. You've probably heard me say that before if you follow my webinars. And that's the truth. You know, that's one of my favorite things to say. It really is. It all starts with a happy tenant. You know, a good tenant and a happy tenant. They pay their rent on time, and they agree to fair rental increases, and they don't cause problems at the property or destroy the units either. So, you know, a happy tenant equals a happy investor. So we ended up putting a little more into this property, about $230,000 over the life of the investment, but we sold it for $990, and we achieved just above the initial target, about 11.7 annualized cash return to investors. We initially targeted around an 11 on this property. So, I don't think we sold it at the best time either. You know, it was time to sell the building, but we sold it August of 2024. It was not a great market to sell into. So, you know, probably it's you know, you're always guessing, I should have sold 2 years or the market was better, but you know, it is what it is. We did fine on this. Our investors did fine on this, and you move on. So that's always how some deals go, but we did absolutely fine. It is hard to time the market. Of course, you never know what tomorrow holds. Here's some additional exits and acquisitions. So right now we're working on a 21 unit in Bayonne, New Jersey. Now, we've had some challenges with this property. There's no doubt about it. First of all, we did buy it probably at the height of the market. We're buying it when prices were very high, about 2.5 years ago or so, February 2023. We're around a 4.5 cap or so, where the properties are now going around 6 caps in those markets. So that's one of the challenges. You know, market cycles come and go, and we do plan to exit this property in a better market cycle. It's not time to exit it yet, but that's one of the challenges with this asset. Secondly, we've been installing mini splits in this building. We completed our mini split installation. We converted the old heating system over to separate heating systems throughout the building. But we were initially told by the city we didn't need permits. Then halfway through, they said, well, actually, you do need permits. And then we had to get architectural drawings done and load calculations and upgrade the electric to the building and upgrade meters. So we ran into some challenges, some delays there. The biggest issue really was that we had 7 units vacant at that time. And the city said, you know what, you have to put a pause on renovating those 7 vacant units while you get these mini split permits closed out, which made absolutely no sense. But the town was a little difficult to work with. And they'd say, okay, now you got to give us this. And we would get that item requested. And then we would, oh, and we need this. And then so it was a piecemeal request where every month they'd ask for something new. We'd run out and get it, and architectural drawings, load calculations, new electric meters. And then they'd say, okay, good work. Now you need to go with this. So it was kind of this constantly chasing our tail with the city. We finally got it done. We installed all 21 mini splits. We saved $21,000 in heating costs by moving the heating off our books. Now the units do also have air conditioning. Instead of using window units, as you can see in the pictures there, now they all have nice air conditioning throughout with energy efficient mini splits throughout the building. So we've made it a nicer building, more of a Class B feel with air conditioning throughout. We've saved $21,000 on heating costs. We finished renovating all those 7 units. We got those units leased up, and we do expect to start distributing cash flow, albeit probably about 6 months late on this asset, but we do expect to start distributing cash flow hopefully by the end of the year or so on this building to investors. And then we'll aim to refinance ideally next year, the year after, or possibly just sell the asset depending on where the market is. The initial strategy with this building was to refinance in perpetuity. Chances are we're going to go with a plan B on this building, which is to sell the asset as cap rates ideally compress into the future. As markets do cycle, we expect the markets to cycle back to a bit of a seller's market. At some point in the future, we'll then sell the asset, and we should be able to achieve target returns to investors here. We've increased the rent by 16.6% on this building. We've turned over 12 units. We had a huge contingency. We estimated a large buffer for renovation funds. We also estimated a lot more than it actually cost to remove the oil tank. So because of that, we had a very large extra capitalized renovation budget for this building in Bayonne. And that allowed us to have all the funds to do these renovations. And that's why we underwrite conservatively, because you never know what you're going to run into with bureaucrats and townships or challenges or vacant units and permits and so on. And those are the challenges of repositioning apartment buildings, especially here in North Jersey. And, so we learn from every experience as well. Looking back, we probably wouldn't have done the mini splits, knowing how much work it was with the permitting and so on, and how difficult the town would be. So we learned something from every single experience. But again, the building is really nicely repositioned at this point. It is stabilized. It's fully occupied. It's making a great income, and we should be able to achieve our target returns here in the coming years for this property in Bayonne, New Jersey. There's the property in Summer Street. We in Patterson, we're selling there. We increased rent about 52% on that building over the life of the investment. That is for sale on the market now. It's just about to hit the market. And here's a 25 unit we bought and sold in Paulsboro, New Jersey. This was actually the first apartment building Seth and I ever did together. And boy, did we take our licks on this one. We learned, we had to develop our own management company. We ended up firing 2 different management companies and developing our own. We sold it for a nice profit. We achieved right around investor target returns. We were targeting about 8.5% annualized cash on cash. I think we got an 8.4% to investors. So we learned a lot from it, and that was our start there. We sold that in 2016 and then never looked back. So we learned so much from every building we do, every project we do. We're always getting better, and we're always explaining to our investors how we're solving these problems as they come along. Because one thing's for sure, you're going to run into snags whenever you're repositioning apartment buildings or doing any type of project in any industry. And whenever we run into those problems, we come to our investors with solutions instead of problems. So they learn a lot actually from our monthly updates by explaining how we're fixing the problems we're running into. And as we stabilize the asset, you tend to have a lot less problems as well. Here's a building we just bought in Passaic, New Jersey. This building, we've distributed over $42,000 to investors already. We've owned it for just about 6 months here, not even. We bought it at the very end of December. Now it's early June, so a little over 5 months we own this. We've hit both distributions here to investors. One right after we bought the property, another one after Q2 or Q1 actually on the building. So this building here, we have a target refinance of about 81% return of capital after year 3. We have a target cash and cash post-stabilization. Once we're stabilized, we've repositioned the asset. We hope to achieve about a 9.7% cash on cash return and then refinance the asset. We bought it for $7.6 million. We'll put about almost about $1.1 million into the property. To the family office share class, we have a target annualized IRR of 20.3% and target annualized Class B share cash on cash return of 9.2%. 42 units in Passaic, New Jersey, right here by the downtown area, targeting about a 2x equity multiple on this and we plan to refinance 3 months in, then 3 years in, and then sell it 5 years into the project. Here's the Bayonne property I just touched on as well. Our target returns to investors are about 12% annualized cash on cash return. We do think in the long run we'll be able to achieve that on this asset. Our renovation budget is $622,000 on this property. We plan to renovate and lease about 75% of the units to fair market value. We've already done a little over 50% of the units, so we're almost there. I think we've done 12 out of 21 now, so maybe 60% of the property or so. So we're almost to our goal here of repositioning this asset. We want to increase the total rent by 34%. Rent rolls up about 16.6% since acquisition. We've completed the separate HVAC installations here, the mini splits on that building. Here's 105 Marion Street in Paterson, New Jersey. This building is also on the market. We just listed with Berkadia. Now, this is going to be more of like a bit of a pocket listing. You know, they say LoopNet is where deals go to die. So you don't want to necessarily, when you go to sell your commercial buildings, listed on LoopNet, right? That's like the commercial real estate MLS, because anything on LoopNet, we don't look at. If it's sitting on the internet, it's probably not a good deal. Any good investor worth their weight is going to be looking for off-market pocket deals for investors. So what a group like Berkadia does, one of the largest commercial brokers in the country, they have a list of like 10,000 buyers that buy real estate in New Jersey here. So they market it out to their investors. We're going to be looking to sell this around $4.5 million. Berkadia is marketing it out right now internally to their network. This is 25 fractured condos out of a 31 condo unit building. This is actually an old factory that was repositioned, repurposed into really nice condos, like high ceilings, nice finishings throughout. And we plan to refinance this after 5 years, but you know what? We're just going to sell it because, quite frankly, interest rates where they are right now is not. It doesn't pencil out that well on a refinance. So we're better off selling the asset. See, our goal is to always get the target returns to investors. We've increased the rent 26.2% on this building. We'll look to sell this building, and investors should achieve about a 14% annualized cash on cash on this deal once we sell the building. We have struggled with cash flow on this building. We targeted about a 2% annualized cash flow. Some years we were able to distribute cash flow. Other years we weren't. I think our renovation budget was a little light on this. We ended up putting more than $60,000 into the building and that's where a lot of the cash flow went on this building. So we'll be able to achieve targeted returns through the sale of this asset. But I'd say cash flow is one of the challenges we faced on this building because, again, the renovation budget was a little light. And hey, that's how you learn this business. We bought this in 2020 and, underestimated, even though it was a stabilized, renovated building, how much money you really need to hold in the reserves for renovations as tenants move out and so on. And that's part of the learning process with buildings. And every single project we do, we get better and we learn and we improve the experience for our investors and ideally the returns for them as well. So fear not, as we sell this asset, we should be able to achieve about a 14% annualized cash and cash return to investors. We initially targeted a 12, so we should be able to surpass our initial targets on that one as well. Here's another one in Rahway, New Jersey. This is a beautiful location, really nice property as well. This is down the street from the Rahway train station. And I'll tell you, if you haven't looked at Rahway, check it out. Rahway is an up-and-coming star here in New Jersey. You have this downtown area where there's a nightlife now, there's art centers and so on. You can go down there and catch a live show and music. It's really quite charming. We bought this for $2.75 million. This was a boarding house when we bought it, and we are just about done repurposing it into a apartment building. Now, as far as the actual physical building and the management of it, it's an apartment building. The legal zoning of it is taking a little longer than we'd like, but that should be done over the next few months. So we renovated these units as tenants moved out. We leased them up. We increased the revenue on this building by 67% on this building. So over the last 4 years or so, we bought this in December of 2021. We'll look to refinance this building next year. Ideally, rates come down a little bit. Even so, we'll refinance by the end of next year. We have a ton of equity in this building. It is producing cash flow to investors. We're targeting an annualized 12% annual cash and cash return to investors with this building, including cash flow and refinance. We should be able to achieve that number through the refinance. Um, our original plan was to increase rent roll by about 30% or so. We've far surpassed that on this building. We're very close to now converting this legally to an apartment building. And the reason we're doing that is because an apartment building is more desirable than a boarding house. First of all, the valuation of apartment buildings is greater. It's appraised at a better cap rate, a lower cap rate, a better metric to give you a higher valuation on the building, an apartment building over a boarding house. Also, when it comes to lenders, a lot of lenders don't like boarding houses. They really like apartment buildings. So as we can convert this not only physically and managerial wise to an apartment building, but also zoning wise, legally to an apartment building, we increase the value of this asset in a very strong manner. So that allows us to build value for our investors in this building, increase the value of the building through changing the zoning and just not your usual repositioning as well, which of course we've executed on this building also. So that's a great value add strategy. Take a boarding house, convert it to an apartment building. It's a lot of work though, a lot of work. It's not for the faint at heart, that's for sure. Here's our transaction heat map. So just showing kind of where we've done a lot of deals in New Jersey here. You know, Seth and I, we made our first million for our investors in Newark, New Jersey. Newark's a great city. We continue to invest in Newark. In fact, we might be taking down about 145 units between two buildings in Newark, New Jersey in the coming months. So keep an eye out for that one. We're getting very close on it. We've done about 200 transactions in Essex County alone, about 279 in New Jersey since 2013. We transacted in 11 of New Jersey's 21 counties. You can see we really do focus more on the northern New Jersey market there. You know, also the eastern kind of areas as well, closer to New York City there, Essex, Passaic, Morris, Union. We've done some in Middlesex and, you know, northern Warren and Sussex County as well. I'm surprised we actually haven't done more in Hudson County. It's a very expensive area. You know, we look for a lot of value in our deals, and Hudson County is one of those more expensive markets. So we focus more on the more affordable markets like Essex, Passaic, and Union County. All right, so let's touch base finally here on what we're doing next. So here at People's Capital Group, we try to acquire 1 to 2 apartment buildings a year. Again, we'll look at hundreds of deals to bring our investors one opportunity. This is our next opportunity here at People's Capital Group. This is 78 units in Hackensack, New Jersey. You can see there to the left is the Hackensack Medical Center, Hackensack University Medical Center, part of the Meridian Health Group. It's actually voted the #1 hospital by US News for like the last 5 years. Huge hospital, really is the best hospital by many standards in the state, and we literally border that hospital. It's directly behind this asset, these two 39-unit buildings making 78 units in total. From where we're standing here, taking this picture, behind us is the high school. So this building is literally sandwiched between the #1 hospital in the state and the high school. You can see here on this map that here you can see there's the Beach Street property, 265-275 Beach Street in Hackensack, New Jersey. Here's the Hackensack University Hospital, which takes up this block and this block. Huge complex. You may have been there probably for the wrong reasons. It is a hospital after all. A lot of people I talk to, some of the family offices and investment groups investing in this know it because they've taken parents and family members there, and that's unfortunate. But it is one of the best hospitals, or the best hospital in the state. So, you know, if you need a hospital, that's a good one to go to. And then, of course, across the street from us here, really adjacent to the building, is the Hackensack High School. So great location for high earners in the medical industry and families alike. Here's Beach Street in relation to Manhattan. Of course, it's a 12-minute drive to Manhattan here. Take a bus in about 28 minutes. You could take a train about 38 minutes. Newark Airport's about a 24-minute drive as well. So Hackensack, you know, really one of the more desirable locations in New Jersey. It is in Bergen County, New Jersey. Bergen County, New Jersey is one of the most desirable counties in New Jersey, and one of the highest priced counties in New Jersey as well. So just a great county to be owning in. And here's why we love this deal. Here's why we locked this up completely off market, direct to us, no other bidders in the room. That's how you buy real estate for a great price. Location, location, location. Directly near the number one hospital, as I was saying, and across from the high school. We love the location. Limited inventory with strong rental growth. North Jersey in general, as we were showing in some of the earlier slides, has a limited amount of housing. Hackensack falls right into that category as well. So a housing shortage throughout New Jersey, but also an affordable housing shortage. And I don't necessarily mean like low income housing. I mean like housing that is decently affordably priced. Um, Now, what we see in areas like Hackensack and Bergen County and northern New Jersey areas is you have a lot of real estate that's Class A real estate, new development coming on the market, and this is very expensive real estate. We often underprice those assets by 30 or 40%. Now, when you get into our renovated units, we have quartz countertops. We're going to put washers and dryers in the units. We're going to put recessed lighting, fresh flooring, and make these units really pop, really be a nice high-end unit. So when you're in the unit itself, it'll feel almost like a Class A building. But you'll be able to rent these units for a fraction of what Class A buildings have. Now, we're never going to really compete with Class A. We don't have a pool or a gym or a spa, but instead of paying, 3,100 for a one bedroom, you can rent ours for 2,300. So if you make $80,000 to $120,000 a year, this is an ideal property for you, especially if you work at the hospital, the high school, or somewhere even in the city. So that's the type of demographic we focus on. We're buying this for a great price with a significant value add. We'll put about $2.1 million into this asset to reposition it over the first 3 years. And we expect about an 83% of investors' capital returned upon the refinance at month 36. We're using smart leverage for this. We're utilizing bridge debt, which gives us about 85% loan to cost. That gives us about 70% of the purchase price and 100% of the renovation cost. We also are going to be utilizing something called preferred equity. Preferred equity is an option that we work closely with specific investment groups that we have a good relationship with that are able to invest, asking simply for a high preferred rate of return, but no actual equity ownership. They have equity ownership until they are exited at the refinance. The bottom line is this allows investors to maximize their return on investment, and that's how we achieve these target returns of 19, 20% plus on these opportunities. We also see a serious difference, as the earlier slides are showing. The rent-to-own delta in New Jersey and really the country in general is ridiculous, but especially here in North Jersey, it's so much more affordable to rent than own. And because of that, we expect a very strong demand for our units here. Rents are 50% below market value. Building is a strong in bones, but units are just outdated. You can see here in the pictures, they're not terrible. It's a 95% occupied building, but it's just outdated. So we need to bring the units up to the standards that tenants are looking for. We're not separating out the heat on this building. We're going to stay with the current heat. We're just going to renovate the units interior wise, a little bit in the common area as well, increase the revenue on the building by that 50% difference or so over the first 3 years as we reposition the asset, refinance for a large liquidity event to investors, and then sell at the end of year 5. We are going to be doing a webinar for this opportunity probably June 18th at 6:30 p.m. But here's the deal. I wouldn't wait until June 18th because we already put this out to specific investors in our network. These are ultra high net worth individuals, family offices, and investment groups. These are very savvy investors that underwrite deals on an institutional level and write generally minimum checks of $3 million. What we found was they love the deal. They love the location. They love the value add strategy. They love the numbers on it and the structure of the deal as well. And they like our past performance here, People's Capital Group, and our in-house vertically integrated business model that allows us to keep tight control of these assets and achieve targets time and time again for investors. Because of that, they wrote sizable checks. We filled up most the capital stack before we even sent out an email to our 5,000 investor list. That means there's only 11% left of this capital stack. So we've raised 89% of the capital already on this deal without hitting send on an email. That means probably by June 18th. The reason I say probably we'll do a webinar is because we might not even do the webinar. We might not even blast this out to our network. We might just finish raising the capital with a few more phone calls over the next 2 weeks. So that's why it's important. Schedule a call with a team member over the next few days because this one's going to fill up pretty quick. Again, 89% of the capital has been raised. We're targeting solid IRRs on this, great location, beautiful building with a strong track record in this area here in northern New Jersey. So we're going to execute very well for our investors on this opportunity. So if you want to learn more about this building, it is for accredited investors only. All right, so accredited investor means you have a net worth of $1 million, not including your primary residence. That can include, though, real estate, other real estate investments, stocks, bonds, IRA, or a net worth or a income of $200,000 pre-tax individually, or $300,000 including your spouse. That's an accredited investor. So this building is limited to accredited investors. By the way, we do have available investments for non-accredited investors. So if you're not accredited, you can schedule a call as well, but we can only talk to you about the opportunities for non-accredited investors. This is for accredited investors only. The minimum investment amount is $50,000. And again, without sending out an email, we've raised 89% of the capital. So this one's going to fill up very quickly. There's a good chance we just cancel the webinar in 2 weeks and this one's all done. So after this webinar, we'll see. I know Patrick's schedule is filling up with calls here just from a couple kind of direct emails earlier in the week to specific investors. And there's a link here on the PowerPoint that you can click to schedule a call with a member of our team. But what I'll do is I'll also put that link here in the chat, and you can go ahead and click that link and schedule a call with Patrick, a member of our team. See if you do qualify for this investment, and hopefully you can get in before all the spots fill up. So go ahead and click that link now. You can schedule right on his Calendly for the next few days. And we'll go to our questions here. It looks like there was an issue with the chat. So that's why we couldn't see anyone in the chat. The chat wasn't working. Oh, okay. So that's why we weren't getting much responses. So everyone wrote in the Q&A here, the chat wasn't working. I don't know why. We'll have to correct that in Zoom. Little technical difficulty there. Randy asked which counties. I think we covered that, Randy. The northern New Jersey counties we invest in. Gary, thanks for writing in there. Glad to hear from you. By the way, Gary, I use that thermos you sent me all the time. It's a great thermos. It's great for exercise. I put my protein powder in there. I shake it up every morning. I love that thing. It's huge. You could put a lot of, make a big protein shake, which I can drink like all morning. So, Gary, thank you so much for that gift. One of our favorite investors out of Texas there, and sends great gifts. What a guy. Nice guy. He sent an airplane to my son. Oh, that airplane, he loves that thing. That thing's great. So thank you so much, Gary. We appreciate you. We appreciate your investment, your trust. And we have some sizable checks coming your way on those investments. So we'll talk shortly on that. Here's another individual saying the chat was disabled. Go ahead. You can ask your questions now. You can ask questions anytime during any presentations. I can always answer them at the end. Randy, where are we from? So Randy, I actually live in Basking Ridge myself. Seth lives in Clinton. I have a 3-year-old son. Seth has 2 children, a little boy and a little girl, and another one on the way, like any day now. So that's why Seth's working from home there. And he's happily married as well. So we're both family men, Seth and I. We both live in New Jersey. The county, so I guess, Clinton, New Jersey is what's that? That would be Hunterdon County, I believe. Yeah. I think it's Morris County. I guess the Clinton's in Morris County. And then I live in Morris County, technically, and in Long Hill Township. So yeah, not too far from Somerville here. Seth and I both live about 20 minutes from the office here in Somerville. We're right at 92 East Main Street, and it's a great place to grab lunch. We encourage you to come to the office here. We can schedule a time. You can email us. So schedule a call with Patrick. And then if you're a qualified investor, sometimes investors like to come to the office, actually see our brick and mortar operation here. We can also go walk out to the properties as well. If you're considering an investment here, People's Capital Group, sometimes I'll put together a group of 3 or 4 investors, and we'll go out to some of the properties we're looking to acquire and properties we currently own and are repositioning, kind of give a little tour of our assets. That's always fun. Yes, Randy. So we live about parallel with Newark. We're like right down Route 78. So Newark's like over in like Eastern Jersey. We're over in like Western Jersey, a little more like suburbia Jersey. Uh, I live in like Basking Ridge area. It's a little more rural, yeah. And Seth is kind of a more rural area too. Nice suburban New Jersey, good place to raise your family there. And I grew up in North Jersey. I went to Rowan University. I actually recently wrote and taught a course called Real Estate Entrepreneurship um, at Rowan University, where I also graduated as an entrepreneur major in 2009. Tough market to graduate into. And so I graduated 2009, and I actually taught a course about a year and a half ago. I just did it for one semester. It was a lot more work than I thought, writing and teaching a course, but it was really a great honor and when you write and teach a course about what you do, you learn it so much better. It was an amazing experience. So real estate entrepreneurship, great course. Now Rowan has the course. I told them I couldn't teach it every semester. It was just way too much work. But now they have the course, and hopefully they can find someone who's more available to teach the course. I don't know how great a college professor I was, but I probably could have engaged the class more. I think, you learn so much when you teach a college course. I think if I did it again, I would engage the class more with more like fun activities and stuff. Oh, your wife went there. Okay, that's great. Yeah, it's great. It's a good school. She may have went back when it was called Glassboro State. They've really improved it since then. I don't know when the last time you were down at Rowan University, but it's a much nicer school. They have this whole like downtown area now. They have a hotel there, a Barnes and Noble. I remember when I was there, oh boy, you would have to like walk the ladies home from the party because you didn't know what was going to happen on the walk home through like Frat Row, they would call it. It was not the same school it is today. It's a much nicer school. So I was happy to see that. And Rowan's really improved as a school. I think it's a great school. Good return on investment, I'd say, because the degree is not that much compared to what you see here at private schools around. You go like Seton Hall compared to something like that. So anyway, that was my days at Rowan there. Really enjoyed them. Was honored to go back and write and teach a course. Um, yes, much cleaner now. Absolutely, Randy. I agree. I agree. All right, ladies and gentlemen, so that's it for me tonight. We had an hour allocated for our presentation. We're running a little bit over. I put the link in the chat to schedule a call with Patrick there, a member of our team. He can talk to you about your investment goals, see if they align with what we do here at People's Capital Group, see if you do qualify for this investment, and if there's any spots left when you speak with him. So click that link. It's in the chat. Hopefully you were able to see that. And I don't know if there's an issue with just writing in the chat or with seeing in the chat. Hopefully you can see that there. If you have any other questions, you could email us. You can reply to our email that comes from info@peoplescapitalgroup.com. And we'll be sending out more information. We do a monthly masterclass for investors, and we do a bi-weekly podcast, and we have our in-person event coming up June 25th in Somerset, New Jersey. If you haven't gotten your ticket for that, email us and we'll send you the link to get the ticket to our in-person event in Somerset, New Jersey, coming up June 25th. We expect about 70 investors or so at that building. I think we have over 70 tickets sold right now to that event. So that's coming up June 25th in Somerset, New Jersey. And you should have gotten an email about that already. If you haven't, you'll get one before the event. You can sign up then as well. Thanks a lot. Have a good night.